Many people say, investing is risky, you might lose everything, and that fear keeps them from ever starting. But risk in the market isn't a simple yes or no question. It depends on your time horizon, your strategy, and your behavior. In this video, we break down when investing is truly risky, and when it is one of the safest ways to build wealth over time. What does risk really mean in the stock market? It's crucial to separate short-term risk from long-term risk. Short-term risk is what most people picture, the daily, monthly, or even yearly swings in stock prices. Day by day, the market's direction is almost a coin flip. One study shows that on any given day, stocks are positive only about 53% of the time. This volatility is real and can feel frightening. For instance, if you had invested in the S&P 500 right before the 2008 financial crisis, you would have seen your portfolio fall by nearly 50% in a matter of months. That's a painful drop. However, that's only half the story. The other side is long-term risk, which is the danger of not growing your wealth at all, or worse, losing your purchasing power to inflation because you kept your money out of the market. To continue the 2008 example, investors who panicked and sold locked in the losses. But those who held on through the recovery saw their portfolios fully bounce back by 2013. This shows that while short-term dips are scary, holding for the long term can smooth out that volatility and lead to substantial growth. History paints a clear picture of long-term market performance. Since 1957, the S&P 500 has historically delivered an average annual return of around 10% before inflation, which adjusts to a still impressive 6 to 7% after. Of course, this isn't a straight line up. There are down years, but positive years far outnumber negative ones. An analysis of the 89 years leading up to 2014 found that the S&P 500 had positive returns in approximately 73% of those years, leaving only 27% as negative. When the market does have a down year, the average loss has been around minus 13.77%. But what happens next is key. Historically, the year following a down year has seen an average rebound of about 9.11%. This pattern shows that downturns are often followed by recoveries. Zooming out even further, one study looked at 94 different rolling 5-year periods and found that only 6 of them ended with a negative return. That means over 90% of the time, if you stayed invested for at least 5 years, your investment grew. The data is clear. While short-term losses are a normal part of investing, they become increasingly rare and are overshadowed by gains over longer time horizons. So, if the long-term odds are so favorable, why do so many people lose money? A big reason is trying to beat the market through active trading, a strategy that often fails. Nearly 90% of actively managed funds underperform the S&P 500 over a 10-year period. Several factors contribute to this. First, costs like management fees, transaction costs, and taxes constantly eat away at returns, creating a high hurdle that active managers must overcome just to break even with the market. Behavioral mistakes are another major drag. Many investors fall into the trap of buying high during periods of market hype and selling low out of fear when prices drop. This emotional decision-making almost guarantees poor results compared to those who stay disciplined. While some research suggests that the most active funds might slightly outperform in down markets, by about 4.5% to 6.1% after adjusting for risk and fees, they consistently fail to beat passive funds in rising markets. Since markets rise more often than they fall, this is a losing bet over the long run. Furthermore, by concentrating their portfolios on a few select stocks, active managers risk missing out on the big winner stocks that drive a disproportionate amount of the market's total returns, winners that a diversified index fund captures automatically. The evidence strongly favors a passive, diversified approach over trying to outsmart the market. This brings us to the core difference between short-term and long-term risk. If your time horizon is only 1 year, the risk is significant. Historically, the S&P 500 has experienced a negative return in about 1 out of every 3 years. That's why you should never invest money you'll need in the near future. However, as you extend your time horizon to 5, 10, or even 20 years, the probability of loss dramatically decreases. Short-term market noise becomes less and less relevant. For example, in the entire span from 1996 to mid-2022, a period that included the dot-com bust and the 2008 financial crisis, the S&P 500 finished a calendar year with a decline only 5 times. A long-term mindset acts as a powerful buffer, allowing you to ride out the inevitable corrections, crashes, and subsequent recoveries. Given this understanding, how can you invest while minimizing unnecessary risk? The first and most crucial step is to diversify. By spreading your money across hundreds or thousands of stocks and sectors, typically through low-cost index funds, you avoid the danger of a single company's failure wiping out your portfolio. Second, use time as your greatest ally. The longer you remain invested, the more historical data suggests that market growth will smooth out short-term volatility. This also means you should never invest money you'll need soon. Keep a cash buffer for emergencies and short-term goals. Another key strategy is to rebalance your portfolio periodically, perhaps once a year, to ensure it stays aligned with your original risk tolerance. Finally, be consistent. Using a strategy like dollar-cost averaging, investing a fixed amount of money at regular intervals, helps you avoid the pitfalls of market timing. It forces you to buy more shares when prices are low and fewer when they are high. And when others are panicking during a downturn, that is often the best time to keep investing, as most recoveries begin when market sentiment is at its worst. The truth? Yes, investing is risky in the short term. Prices swing, crashes happen, and temporary losses are unavoidable. But those who fixate on this volatility miss the bigger picture. Over the long term, the historical evidence shows that not investing is the far greater risk, letting inflation silently erode your savings while the market consistently rewards patient, disciplined, and diversified investors. Don't let fear paralyze you. Use proven strategies, avoid common behavioral mistakes, and let time work in your favor.